Coming into the first quarter of 2026, institutional capital was heavily concentrated in high beta tech. The consensus was locked in on a soft landing and a summer of steady rate cuts. Then came day 32 of the escalating conflict between the US, Israel, and Iran. Sirens sounded across Jerusalem as missiles launched, followed by confirmed military strikes hitting critical positions near Mount Sofa in Isfahan. The soft landing narrative evaporated in hours. Portfolios heavily weighted toward growth projections suddenly found themselves caught completely offside on the wrong end of a massive geopolitical shock. The global financial system is currently undergoing a forced, aggressive repricing of risk. The immediate focal point for economic fallout is the maritime blockade choking the Strait of Hormuz. Roughly 1/5 of global oil flows through this narrow channel. That supply is now actively targeted. Looking at the market reaction, Brent crude saw a 50% vertical price spike in a single month, rapidly pushing past $105 a barrel toward $110. That vertical surge triggers an immediate portfolio vacuum. Algorithmic trading models are executing rapid liquidations to cap their downside exposure. Capital is violently rotating away from sectors vulnerable to energy costs, hunting for hard, defensive floors. The sharpest outflows are hitting the U.S. tech sector. Growth valuations are highly sensitive to the cost of borrowing, and this sudden energy tax is driving Treasury yields sharply higher. The Nasdaq Composite is tracing a bearish flag pattern, facing relentless algorithmic selling pressure at resistance. Shifting to the S&P 500, the index has retreated 9.1%, testing structural support at 6350, with the VIX volatility gauge hovering near 30.6. The sell-off is equally severe in Asia. Japan's Nikkei 225 plunged 2.24% in early trading. Japan relies heavily on imported energy via the Strait of Hormuz. When you combine surging crude prices with a weakening yen, the resulting inflationary pressure directly threatens their domestic recovery. And in the Middle East, the Saudi Tadawul index has dropped 13%. Despite being a massive energy producer, the pure proximity risk of retaliatory strikes on its infrastructure heavily outweighs any benefit from higher oil prices. Institutional managers are liquidating assets reliant on high growth projections or imported energy without prejudice. So where is the smart money actually going? In the US, it's migrating to the relative safety of the Dow Jones Industrial Average. The Dow's heavy weighting in defense contractors and industrial blue chips acts as a natural hedge against military escalation. Across the Atlantic, the UK's FTSE 100 actually climbed 1.61%, capturing the bulk of this new war premium. The FTSE is heavily weighted with energy giants like BP and Shell, along with massive mining conglomerates. Right now, it is functioning as a reliable global inflation hedge. We are seeing massive inflows into traditional safe havens. The US dollar index has breached 104.20, and spot gold has surged to $4,380 an ounce. Institutional desks have abandoned future yield projections. The immediate priority is capital preservation and holding hard assets. As we enter the second quarter of 2026, global financial markets are now officially operating on a strict, high-stakes war economy footing. The macro threat here is a rapid re-acceleration of global inflation, driven entirely by the squeeze on global energy supplies. This creates a policy nightmare for the Federal Reserve. Chair Jerome Powell recently signaled that interest rates were in a good place, but a new wave of inflation challenges that stance. Central banks are effectively paralyzed. They cannot cut rates without pouring fuel on energy inflation, and they cannot hike rates without collapsing the fragile floors holding up the equity markets. That brings us to Wednesday, April 1st, when the Indian benchmark indices reopen after a holiday. This chart plots the expected trajectory for the Nifty 50. The index has to suddenly digest 48 hours of global geopolitical escalation. Expect a violent gap-down opening, making the 22,300 support zone the critical level to watch. Until a definitive naval ceasefire is achieved in the Gulf, the strategy is clear. Abandon speculative tech, watch central bank yields closely, and maintain a strict defensive posture.